The IRS has all sorts of rules about what your nonprofit can and can't do and still maintain its 501c3 status. But there's also a question of who can do things within your nonprofit. Well, today I'm going to talk about what the IRS calls disqualified persons. Hi, I'm Greg McRae, founder and CEO of Foundation Group, and welcome to our 501c3 University channel. When it comes to nonprofits, especially 501c3 organizations, one of the IRS's constant concerns is conflict of interest and, by extension, private benefit. Now, this can be a challenge for a nonprofit, whether it's just starting out or has a long history. The concern is mainly about which parties are involved and whether or not decisions are being made at arm's length. Now, these parties can be board members, relatives, employees, donors even, but collectively, they are known as disqualified persons. So let's look at that term, disqualified person. Sounds kind of harsh, doesn't it? Who's disqualified and what are they disqualified from? Well, remember, the IRS wants to ensure that a nonprofit is acting in a way that is in line with its approved 501c3 purpose. That's a given. But the IRS also wants to ensure that no one is privately benefiting simply from being involved with the organization or being related to someone who is. Most commonly, the recipients of private benefit and inurement are board members, officers, maybe employees of the organization. These are the people who are in a position to exercise substantial influence over the affairs of the organization, regardless of whether or not that person actually exercises that influence. The IRS identifies these individuals as disqualified persons. But disqualified from what? The IRS really doesn't answer that directly, but it basically means they're disqualified from being transacted with in a manner the same as those that don't have the same level of influence. Extra care must be exercised to ensure that you're doing things at arm's length. The IRS defines a disqualified person as an officer, director, or a trustee of the organization, a key employee or someone who's paid $150,000 or more per year by the organization and or makes key management decisions in a day-to-day capacity, a substantial contributor, a donor, who gives more than 2% of the total contributions received by an organization from its inception, a family member of one of the above, and or a foundation, trust, or corporation of which someone owns or controls more than 35% of it. While the criteria to be classified as a disqualified person are the same in both a public charity and a private foundation, the IRS views them very differently depending on the type of the organization involved. In a private foundation, the IRS has very strict rules for transactions with a disqualified person. It's not that the organization can't transact with a disqualified person, it's just more heavily scrutinized. And this is because private foundations are allowed to have a closely controlled board of directors, which makes making arm's length decisions next to impossible. The IRS never assumes that an arm's length decision has occurred in a private foundation, resulting in a much higher level of scrutiny. However, the IRS does not prohibit a disqualified person from being hired by a foundation if the following conditions are met. Number one, the defined job is for personal services, usually of a professional nature like accounting or legal. Two, the job is ordinary and necessary, meaning someone's got to do it. And number three, compensation is reasonable. Now, these three conditions are way more complex than they sound, and I can't go into a lot of detail in this video. In fact, we're going to do another video specifically on how to hire disqualified persons in a private foundation. In a public charity, a disqualified person must still meet these same requirements generally if they're being compensated, but there's much less scrutiny by the IRS. Public charities are required to have the majority of their board of directors be unrelated to each other. More on that in the next video. So it is much more feasible for an arm's length decision to be made. Arm's length can be accomplished through the recusal of the disqualified person and any other parties related to that person, regardless of whether it's a private foundation or a public charity. If there's a non-arm's length transaction with a disqualified person and prohibited private benefit does occur, this can result in penalties called intermediate sanctions. Now, these penalties are assessed by the IRS directly against individual board members, not the organization itself. Penalties start at 25% of the amount determined of prohibited benefit and can rise to 200% if the situation is not fixed in a timely manner. This also includes the likelihood that the organization will undergo a much more comprehensive audit. At the end of the day, the nonprofit, whether it's a private foundation or a public charity, it's obligated to fulfill its exempt purpose to the public, not benefit the insiders running it. We're going to expand on this topic in some coming videos. Well, that's it for this one. If you liked this video, please click the like button. If you haven't subscribed already, go ahead and do that. Click the bell icon to be notified of new content when we post it. Thanks for watching, and we'll see you next time.